Very good day to everyone. So ICAI has now rolled out the MTP Series I for CA Intermediate Taxation Group 1 paper, and this is relevant for the January 2025 examination. So this is Series 1 MTP, and in this video we are going to discuss the case scenario, MCQs and other MCQs, and we are going to discuss the complete solution with full working steps. And the reason is that in the answers released by the ICAI, they just give the final answer. They don't provide the working steps. So there is a need for some clarity as to what is the logic and reasoning behind arriving at the correct answer. So consequently, we won't be discussing the solutions to the descriptive questions because anyways in the MTP answer document, the full working notes for those answers have been provided. So I am providing the link to this MTP, the question as well as the answer in the description box. So you can go and take a look, and if you have attempted and solved the MTP at your own end, then I will suggest that you watch this video to understand the working steps behind the answers to various MCQs. So we will begin with income tax first, and then we will move on to GST. So first, income tax law, and this is the case scenario 1, and we straight away move to the first question and see what should be the correct answer. So first question is, what would be the residential status of Mr. Raja for AY 24-25? And the correct answer provided by ICAI is RNOR, resident but not ordinarily resident in India. And the relevant information which is given in the question is that Mr. Raja is an Indian citizen, okay, and he has set up his business in Canada, and he is residing in Canada since 2009. And then it's given that he visited India for 124 days during the current previous year, and before that he visited India in a total for 366 days during the preceding 4 previous years: 2019, 20, 2021, 21, 22, and 22, 23. So preceding 4 previous years. This is the information that we have got in the question. Now, how do we determine the residential status? So if you look at the provisions for determining residential status, first of all, we need to check the special rules, and we need to see whether any special rule applies. So if you look at the visit rule and visit and income rule, it applies to a citizen of India or person of Indian origin who comes on a visit to India in the previous year. So in our question, Mr. Raja is a citizen of India and he comes on a visit to India in the previous year for 124 days. Now, what is important is to find out the amount of total income other than income from foreign sources. Okay. If this is up to 15 lakh in the previous year, then visit rule applies, in which case Mr. Raja will become a resident if he is in India for 182 days or more in the previous year. However, if his total income other than income from foreign sources is more than 15 lakh in the previous year, then visit and income rule will apply, and then instead of 182-day threshold, the threshold will be 120 days. So he will be a resident if he is in India for 120 days or more in the previous year, and he is in India for 365 days or more in the preceding 4 previous years. So basically what we need to find out first is the total income other than income from foreign sources in both the cases. And then accordingly either the visit rule will apply or the visit and income rule will apply. So as we know, total income which is other than income from foreign sources, in other words, it means total income from Indian sources. Okay, and this basically is the total income computed after excluding income from foreign sources. So total income refers to the taxable income. So total income as computed under the Act, and from that we need to count only the income from Indian sources. We need to exclude the income from foreign sources. And as we know, what is income from foreign sources? It is income which accrues or arises outside India, but it should not be deemed to accrue or arise in India, right? However, if the income is derived from a business which is controlled in India or a profession which is set up in India, then it will be treated as income from Indian sources, not income from foreign sources. So this is how we need to compute income, total income, which is other than income from foreign sources. And then accordingly, we will be able to determine the residential status. So for that, if we look at the question, so first of all, we see that he has set up his business in Canada and is residing in Canada. So this means he has got some business income also, and business income is accruing or arising outside India, that is in Canada. And the business is also not controlled in India. So this is foreign income. That this is income from foreign sources. This is not to be treated as income from Indian sources. So this will not enter the computation of total income, which is other than income from foreign sources. Okay. Next, we are told that he owns a house property in Canada. So house property is in Canada, and the income is accruing and arising outside India. House property is situated outside India, so income is not deemed to accrue or arise in India also. So this is also income from foreign sources. So this is also not to be taken into account. Now we are told that he has a flat in Delhi. So since the flat is in Delhi, the flat is in India, the income is accruing or arising in India, and it is also deemed to accrue or arise in India because the house property is located in India. So the income from such house property will enter the computation of total income other than income from foreign sources, because it will be part of total income uh, from Indian sources. So we need to compute this income, and this is a flat which has been given out on rent, monthly rent of 32,500 since April 2023. So for the entire year, 12 months, the rent comes to 3,90,000. And then the annual property tax of Delhi flat is 40,000, which is paid by Mr. Raja whenever he comes to India. So since in the current year he has come to India, he has paid rupees 40,000. So this municipal taxes of 40,000 needs to be reduced. And this will give the NAV of 3,50,000, from which 30% standard deduction of 1,05,000 will be deducted. And then we need to see the interest on loan which he has taken from Canara Bank of 34 lakh for purchase. Okay, and the interest for the current financial year is 3,14,000. So this is the interest which has been taken for purchase of house property, and uh, the flat has been given on rent. So this property is basically a let out property. So the entire amount of 3,14,000 will be available as deduction. So we deduct the entire interest, and the result is a loss of 69,000 from this flat. Next, we are told that he has a house in Ranchi which was sold way back in 2021, and he has received arrears of rent of 2,96,000 in February 2024. That means in the current year, which was not taxed earlier. Since it was not taxed earlier, it will now be taxed as unrealized rent after giving deduction of 30%. That means 88,800 will be deducted, and the balance 2,07,200 will be taxable under the head income from house property. Even if the house property in question does not, Mr. Raja is not the owner of that house property in the current previous year, even then the unrealized rent will be taxable. So the balance will be 2,07,200, and if we aggregate the loss above and the income, the final net income under the head income from house property will come to 138,200. Then there is the detail of capital gain which has arisen because he has sold 10,000 listed shares of A Limited, which is an Indian company. Since it is an Indian company, the income will accrue or arise in India, and it is also deemed to accrue or arise in India since the capital asset is situated in India, and therefore this will also enter the computation of total income other than income from foreign sources. So we will need to figure out the amount of capital gain. So full value of consideration is what? 480 per share for 10,000 shares, and this comes to 48 lakh. Next, we need to figure out the cost of acquisition. Now here we see that STT was paid at the time of acquisition and transfer, and A Limited is an Indian company, so STT was paid, that means shares are listed, so section 112A will apply, and the shares have been acquired before 31st of January 2018. So we should know this provision, that in case of equity shares referred under section 112A acquired before 1st February 2018, the cost of acquisition is higher of what? Higher of A or B, where A is the actual cost of acquisition and B is the lower of FMB as on 31st January 2018, or full value of consideration. And how do we determine FMB as on 31st January 2018? Where the capital asset is listed on any recognized stock exchange as on this date, and the asset was traded on this date, then the highest price quoted becomes the FMB. Highest price quoted on this date becomes the FMB. So the cost of acquisition special provisions will apply, which will be the higher of actual cost of acquisition. Actual cost of acquisition is rupees 100 per share. For 10,000 shares, it means 10 lakh rupees. And the next point is lower of fair market value or full value of consideration. Now, the fair market value, we are told that on 31st January 2018, shares were traded on the recognized stock exchange where the highest price was 300 per share. So 300 per shares for 10,000 shares means 30 lakh rupees. And the full value of consideration at 480 is 48 lakh. So lower of these two is 30 lakh, and the higher of 10 lakh or 30 lakh becomes the cost of acquisition. So 30 lakh becomes the cost of acquisition. Consequently, the long-term capital gain under 112A becomes 18 lakh rupees. Okay, becomes 18 lakh rupees. So now we can determine the total income from Indian sources. That means total income other than income from foreign sources. So 18 lakh becomes the capital gain, 138200 income from house property. And what about deduction under section 80C? Because there is a principal repayment of 80,000. But this will not be allowed because Mr. Raja wants to pay tax under default tax regime under 115 BSC, under which 80C deduction is blocked. So 19,30,200 will be the total income, which is other than income from foreign sources, and this is more than the threshold of 15 lakh. Now, since this is more than the threshold of 15 lakh, visit and income rule will begin to apply. And here, Mr. Raja will become a resident if he is in India for 120 days or more in the previous year, and for 365 days or more in the preceding 4 previous years. Both these conditions are getting satisfied as per the facts of the question. So he becomes a resident. Now, if he uh, uh, is a person becoming a resident and he is in India for less than 182 days, since he is in India for 124 days, this condition is met. In that case, he will be treated as a resident but not ordinarily resident, RNOR, under the visit and income rule. So his residential status will be what? His residential status will be resident but not ordinarily resident in India. Okay, so this is how we arrive at the answer. So in nutshell, we will need to compute the total income other than income from foreign sources, and since it is more than 15 lakh, we will need to apply the visit and income rule and then accordingly determine the residential status as that of RNOR. Second question is, what would be the amount of income taxable under the head income from house property? So we have already computed this. It will be 138200. So this is the correct answer. And then the third question is, what amount of capital gain would arise? And this is also something that we have already computed above. This is 18 lakh. So this is the correct answer. So this brings us to the end of case scenario number 1. Case scenario number 2 is regarding Mr. Anay. And what is the first question? What would be the amount of deduction available to Mr. Anay under Chapter VIA for AY 24-25? And question states that he has shifted out of default tax regime under Section 115 BSE. That means The optional tax regime is applicable and therefore all deductions under Chapter VIA are available to Mr. Anay. So let's see what are the deductions that are available. So he's a CEO of XYZ Enterprise Limited. He earns salary, LTCG on sale of listed equity shares. He earns interest on savings bank account. And since this is interest on savings bank account, deduction under Section 80 TTA will be available to him, but to the extent of rupees 10,000. So this is one. Then we are told that he took a loan from State Bank of India on 27th October 2021 for repairing his house, which is self-occupied at Delhi, and paid interest of 80,000 and 1,50,000 towards principal amount. So repayment of principal amount. Is deduction available under Section 80C for repayment of principal amount? No, it is not available. Why? Because under 80C, repayment of principal amount where loan is available as deduction, where loan is taken for what? For purchase or construction of residential house property. And this has been taken for repair, so 80C is not available. And for the same reason, 80EE deduction is also not available, because for 80EE, the loan should have been taken for acquisition of house property. So both 80EE and 80C are not available. Next, we come to payment of medical insurance premium for health policy. So 80D, medical premium for brother is not eligible. For parents, 17,670 by check. Entire 17,670 will be available because the parents will be a senior citizen, because Mr. Anay is 52 years, so we can assume that parents will be senior citizen. So 50,000 will be the limit. So entire 17,670 becomes eligible. For self and wife, 21,000 by check. So the overall limit is 25,000. So 21,000 becomes eligible for deduction. And next we are told that he incurred 6,400 towards preventive health checkup of his wife in cash. So even if it is in cash, for preventive health checkup, deduction is allowed under 80D. But for preventive health checkup, the overall limit is 5,000. But still we will be able to provide deduction of only 4,000, because 21 plus 4 becomes 25. So overall deduction for self and wife cannot exceed 25,000. So 4,000 becomes deduction on this count. So total deduction under 80D becomes 42670. Okay. So this was about 80D. Now we come to the next point. He deposited 1 lakh towards PPF. So under 80C, this 1 lakh will be allowed as deduction. Then we are told that he deposited 50,000 and 2,50,000 towards Tier 1 and Tier 2 NPS accounts respectively. So we should know that Tier 1 NPS contribution is covered under 80CCD. Tier 2 NPS contribution is covered under 80C. But under 80C, deduction for Tier 2 NPS contribution is allowed only to a central government employee, which is not the case here. So 80C will not be allowed in respect of 2,50,000. What will be allowed is 80CCD, for which he has contributed 50,000. Now, if you look at, so what is he? He is a CEO of a private enterprise. So employer is a private employer, and if you look at 80CCD, so where the SSE is employed by an employer and contribution for his contribution, deduction under 80CCD1 is up to 10% of his salary in the previous year, and then additional deduction under 80CCD1B of up to 50,000 is also provided. So in any case, the deduction under 80CCD can be allowed to him of rupees 50,000, which we have noted here. So if you aggregate all these amounts which we have discussed, 80TTA, 80D, 80C and 80CCD, the aggregate will come to 202,670, which is the answer. So now we can move to the next question. Question 2. Assume that for the purpose of answering this question alone, that Mr. Anay pays rent of 65,000 per month for his rented house at Mumbai to Mr. C, a resident individual. Is he liable to deduct TDS? If so, what will be the rate and amount of TDS? And the correct answer is yes. He will be liable to deduct TDS at 5%, amounting to 39,000 in the month of March 2024. So which section will apply here? Which section will apply here? So for rent, we have section 194I. For 194I, the payer should be any person not being an individual or HUF, or a specified individual or HUF. Specified individual, an individual who is in business or profession and where the turnover from business is more than 1 crore, or gross receipts in profession is more than 50 lakh in the preceding financial year. And here in our case, Mr. Anay is salaried employee, so he is not running a business or profession, so he is not covered under 194I. So then we move to section 194B. An individual who is not referred under section 194I, and pay should be a resident, which is also the case in our question, that the payment has been made to a resident. Income is by way of rent, and in such case the rate of TDS is 5%, and TDS is to be deducted from the rent for the last month of the previous year. Okay, and TDS is not deductible where the rent is not more than 50,000 for a month or part of a month. So in our case, the rent is exceeding this limit, so 194IB applies, and the rate is 5%. And then the 65,000 per month for the entire year comes to 7,80,000. 5% of this comes to 39,000. So the entire TDS of 39,000 will be deducted only in the last month of the previous year. That means March 2024. Next question is, what would be the amount of interest chargeable under section 234B on account of short payment of advance tax? So 234B, and the answer is nil. So basically no interest will be leviable under section 234B. So how will we arrive at this answer? So we need to quickly recap the provisions of 234B. This is interest for default in payment of advance tax. Now interest under 234B is chargeable when he is liable to pay advance tax. Okay, when he is liable to pay advance tax, but either he has failed to pay such tax, or the advance tax paid by him is less than 90% of SS tax. So first we need to find out whether he is liable to pay advance tax. For that, we need to figure out what is the amount of advance tax that needs to be paid and whether it needs to be paid in the first place. So advance tax needs to be paid where the amount of advance tax payable is not less than rupees 10,000, then advance tax is payable. If advance tax is less than rupees 10,000, then it is not payable. So first we need to compute the amount of advance tax payable. And how do we compute that? The advance tax which is supposed to be paid is to be computed in this particular method. So we need to calculate the tax on the current income at the rates in force. Okay. From that, we need to reduce the rebate under section 87A, add surcharge and cess at 4%. And then we need to reduce TDS or TCS deducted or collected during the financial year. So this needs to be reduced. So ultimately, the amount that is resulting is the advance tax payable. And if that is more than 10,000, that means advance tax is liable to be paid. And once advance tax is liable to be paid, then we need to find out whether he has completely failed to pay such tax, or whether the advance tax paid by him is less than 90% of SS tax. For that, we then need to find out the amount of SS tax. Okay. And what is SS tax? For SS tax, we need to compute the tax on the total income. Okay. Tax on total income less TDS deducted or TCS collected. Okay. Or relief under section 89 or AMT credit under section 115 JD. So if 234B interest is leviable as per this particular provision, then we need to compute the interest. Then we need to compute the interest as per this rate of interest and as per this formula. So what we need to find out is whether what is the amount of advance tax which is payable and whether there is liability to pay advance tax. And then, since in the question we know that he has paid some amount of advance tax, we need to find out whether the advance tax paid by him is less than 90% of the SS tax. If it is less than 90% of SS tax, then 234B will apply, else interest will not be payable under 234B. Okay. So now we move to our question. And now for this, we need to figure out the amount of advance tax which is payable. For that, we need to compute the amount of advance tax. And for that, we need to first figure out the amount of total income, and then we need to compute the tax on total income at the rates in force. And since Mr. Anay has shifted out of the default tax regime, the optional tax regime becomes applicable. So we need to compute the total income as well as the rate of tax as per the optional tax regime. So if we look at the question, the first amount of income is salary of 1 crore 65 lakh. So 1 crore 65 lakh is what we put here. Then we have LTCG on sale of listed equity shares, that means 112A section, okay, STT paid, amounting to 106,500. Okay, before that, since it is mentioned that he earned salary of 1 crore 65 lakh, it is not mentioned that this amount of 1 crore 65 lakh is the income computed under the head salaries. That means we must give the standard deduction of 50,000 rupees, which we have given. Okay, so LTCG of 106,500 under section 112A comes here. This is supposed to be added. Then interest on savings bank account 482778 will be added. Moving further, we find that he has taken a loan from SBI for repairing his house, and the house is self-occupied. So this is a self-occupied house property, and this is a case of repair of his house for which a loan has been taken, and interest has been paid to the extent of 80,000. So when there is a self-occupied property and the interest has been paid on loan which has been taken for repair, what is the limit for the deduction of interest under section 24B? It is not the full amount of interest, but only the deduction is limited to the extent of 30,000 rupees. So 80,000 will be deductible only till the extent of 30,000 rupees. So we deduct 30,000 rupees here. Okay. Next, we deduct the deductions under chapter VIA that we computed for question number 1, which was 202,670. So these are the plus minus that needs to be done for arriving the amount of total income, which then comes to 1 crore 68 lakh 6,610 rounded off. So on this total income, we now need to compute the amount of tax at the rates in force. So first we will need to compute tax on the LTCG under section 112A of 106,500. We will need to compute tax at 10% on amount exceeding 1 lakh rupees. So 10% on 6,500, it will come to 650 rupees. This will be the tax under section 112A. Then we will compute the balance total income, which will be what? 168,06610 minus 106,500. So that will become the balance regular income on which we will compute tax at the regular rates in force as applicable for the optional tax regime. And then we will add the tax as per the regular rates and the tax under 112A, and to that aggregate we will apply the amount of surcharge, which will be at the rate of 15%. Why? Because here the total income is more than 1 crore and up to 2 crore. Okay, so surcharge at the rate of 15%, tax and surcharge we will need to aggregate, and to that we will add cess at the rate of 4%. So tax on total income will come to 576,852.6. And as we discussed some time back, we will need to reduce the amount of TDS that has been deducted. TDS that has been deducted to figure out the amount of advance tax payable. So we are told that his employer has deducted tax at the source of 51,89,000. So this is what we reduce, and this is the amount that we get advance tax payable 579,526. Since this is more than 10,000, there is liability to pay advance tax. There is liability to pay advance tax. Now here he has paid 5,30,000 as advance tax. So for 234B, what we need to find out whether the advance tax paid is less than 90% of assessed tax. For assessed tax, how do we do it? We figure out tax on total income and then we reduce TDS, which has been deducted by the employer in our question. The other points are not relevant to our case. So Tax on total income was 5768526, and the amount of tax which has been deducted is 5189,000. So 579526 is also the amount of SS tax, and the advance tax has been paid of 5,30,000. Now if we compute 5,30,000 as a percentage of 579526, it will come to 91.45%. So advance tax paid is 91.45% of SS tax. It is not less than 90% of SS tax. Therefore, interest under section 234B will be not applicable. It will not be levied, and consequently the answer 234B interest is nil. Okay. Next MCQ is number 3. And what we are asked to figure out is, in whose hands the income of PR shall be taxable. Also compute the amount of income that shall be taxable if both parents pay tax under the default tax regime. And the correct answer is D. Income of 13,000 will be taxable in the hands of PR's father or mother whose income before this clubbing is higher. So this is a case of Pia, who is the minor child, and the minor child gets a gift of 20 lakh from her father's friend. So when we are talking about gift, it is a gift of cash of 20 lakh from father's friend. So which section becomes applicable for gifts? 56(2)(x) under income from other sources. The amount is more than 50,000, so entire amount becomes taxable under 56(2)(x), and also father's friend is not a relative. So exemption for relative is not applicable. So 56(2)(x) straight away 20 lakh becomes taxable. In whose hands? So 64(1)(a) becomes applicable. Clubbing of income, 64(1)(a), income of minor child is supposed to be clubbed with the income of parent whose total income before such clubbing is greater. Before such clubbing is greater. Okay. Further, we are said that she deposited this amount in a fixed deposit in the bank, and on the said deposit interest of 13,000 was earned during previous year 23-24. So this interest of 13,000 also becomes the income of minor child, which again will be clubbed in the hands of the parent. So 20 lakh and 13,000 will need to be clubbed under section 64(1)(a). And then the question is whether now we will need to give the exemption under section 32 of 1,500 from this particular amount. So the answer is no. Why? Because both parents pay tax under the default tax regime. So irrespective of the parent in whose hands the income will be clubbed, exemption will not be allowed because both parents pay tax under default tax regime 115 BAC, under which exemption under 1032 is blocked. It is not allowed. So consequently 20 lakh plus 13,000, that means 20 lakh 13,000 will be taxable. It will be clubbed in the hands of father or mother whose income before this clubbing is higher. Okay. Last question under income tax. This is a question where we are asked to find out the amount eligible for deduction under section 80DD. Under 80DD. So Rohit is a resident Indian. He has incurred 15,000 for medical treatment of dependent brother, who is a person with severe disability, and he has deposited 20,000 with LIC for maintenance, and he has shifted out of default tax regime. So optional tax regime is applicable. So deduction under 80DD will be applicable. It will be eligible. So SSC is an individual resident in India as per our question, and he has incurred expenditure for medical treatment of dependent and deposited amount under approved scheme of LIC, and dependent includes brother. Okay, and the brother is dependent on him, and this is a case of severe disability. So flat deduction of 1,25,000 is supposed to be allowed. Okay, irrespective of the amount of actual expenditure. So flat deduction of 1,25,000 is to be allowed. So therefore this becomes the answer. So this brings us to the end of income tax, and now we move to the GST portion. So this is the GST portion, and we move to the case scenario number 1, which is in respect of Future Insurance Limited, which is an insurance company providing life and general insurance services across India. And we straight away move to the first question, which is determine the services on which the company is liable to pay tax under reverse charge. Services availed from insurance agents, services availed from RR Travels Private Limited. None of the services attract RCM, and both or both A and B, and the correct answer is services availed from insurance agents. And the question states that Future Insurance Limited secures its business through various insurance agents. These agents include individuals, firm, LLP, and private limited company, and all of them are licensed under the Insurance Act. So if you look at the provisions for reverse charge, entry number 7 of RCM notification becomes applicable, where services supplied by insurance agent to any person carrying on insurance business is liable to reverse charge. It doesn't matter whether the agent is individual, firm, LLP, private limited company, or whatever. So in this case, RCM will become applicable, and accordingly, this is the correct answer. But what about the other options? Other option is service availed from RR Travels Private Limited. So what service has been availed here? The company avails services of renting of motor vehicles for its employees in Pan India through RR Travels Private Limited. So a company has rendered services to a company. RR Travels is a company and Future Insurance is a company. So body corporate to body corporate. Cost of fuel is included in consideration, and RR Travels has charged 5% GST and informed that it is claiming ITC only in respect of the same line of business. So is RCM applicable in this case? So let's see the provisions. Provisions for renting of motor vehicle. RCM is applicable where any person other than a body corporate, non-body corporate, supplies such service to a body corporate, which is not the case in our hand because it's a body corporate to body corporate service. So RCM is not applicable. So even if the cost of fuel is included in consideration and the supplier is applying 5% tax with limited ITC, that means input services in the same line of business, even then RCM will not apply because it is a service from body corporate to body corporate. So in the result, the answer to option B will be that it is an incorrect option. Consequently, C is also incorrect and D is also incorrect. So A becomes the correct option. Next question, compute the total value of taxable supply made by Future Insurance Limited for the month of May. And the correct answer is 23 lakh. Let's see how we arrive at 23 lakh. So this is the list of or the details of insurance business for the month of May. And the first is premium received on Pradhan Mantri Jan Dhan Yojana. So this is exempt. For insurance and pension under general insurance, we see that entry 35 of exemption notification, all these schemes are exempt. So Pradhan Mantri, where is Pradhan Mantri Jan Dhan Yojana? This is under life insurance. Pradhan Mantri Jan Dhan Yojana. So this is exempt. Okay. This becomes exempt. Premium received on Aam Aadmi Bima Yojana. So Aam Aadmi Bima Yojana is also exempt. So again, this 3 lakh becomes exempt. Premium received on life micro insurance product having a sum assured of 2.5 lakh. So micro insurance products. What about micro insurance products? So life micro insurance product is exempt, having maximum amount of cover of 2 lakh. So if the cover exceeds 2 lakh, then exemption will not be available. Since the cover of 2.5 lakh is exceeding 2 lakh, 4 lakh will become taxable. It will not remain exempt. Premium received on reinsurance of group personal accident policy for self-employed women. Okay, so this is the case of reinsurance. So group personal accident for self-employed women by itself is exempt, and reinsurance of the insurance schemes referred under this entry 35 is also exempt. So reinsurance of this particular policy is exempt, so it will not be taxable, so 1 lakh will become exempt. Premium paid on fire and special perils policy of various business units and premium received on money back policies issued. This is not exempt. This is not listed under the list of these exempt policies anywhere. So this is not exempt. This becomes taxable, and accordingly 7 lakh becomes taxable and 12 lakh becomes taxable, and the total then comes to 23 lakh. Okay. Next question is, determine the amount of ITC that can be claimed by Future Insurance Limited, and the correct answer is given as 3,80,000. Let's see. So this is the list of supplies received in the month of May and details of GST paid on such supplies. The first is GST paid on purchase of car for use of managing director. So this will be blocked because, as we know, ITC is blocked in respect of motor vehicle for transportation of persons having approved seating capacity of less than or equal to 13 persons, including the driver. And therefore the only exception is where such conveyance is used for either further supply of such conveyance or transportation of passengers or imparting training on driving, or when such conveyance is used for transportation of goods. Only in that case ITC is not blocked, otherwise it is blocked. So in our case ITC will not be available. Second is GST paid on bus seating capacity for 14 persons, so it is exceeding 13 persons, purchased by the company for transportation of its employees from the residence to office. Since the capacity is more than 13 persons, therefore ITC will not be blocked, ITC will be available, so 3 lakh will be available. Third is GST of 80,000 was paid on general insurance taken from Amity Insurance Limited, so another insurance company, for motor vehicles for transportation of persons with seating capacity less than or equal to 13 persons, including the driver, which were used in transportation of staff of the company. So the capacity is 13 or less, including the driver. So ITC is blocked. And in respect of such conveyance and services of general insurance, insofar as they relate to such ineligible conveyance, ITC is also blocked. However, exception is where such services are received by a taxable person, that means Future Insurance in our case, which is engaged in supply of general insurance services in respect of such ineligible conveyance insured by him. So on account of this particular provision, ITC will be available. So 80,000 will be available, and consequently the total will be 3,80,000. Case scenario number 2, Madurai Impex Limited, which is a company, and question number 4 is, after the grant of temporary registration, so temporary registration has been granted. So let's see the question. The company did not opt for registration under GST, but proper officer under GST based on inquiry finds that the company is liable for registration, and he registered the firm on temporary basis on 15 June 2023. So after the grant of such temporary registration, Madurai Impex Limited needs to apply for registration within how many days from the date of grant of temporary registration if no extension has been granted. So here what we need to check are the provisions regarding suo motu registration by the proper officer, in which case an application needs to be submitted for registration within 90 days from the date of grant of such temporary registration. This is the provision, so the correct answer will be 90 days. Next question is, the company needs to file its final return by 30th June 2024. This is the correct answer, and we are told that in the month of March 2024 the company was incurring heavy losses, so it applied for cancellation of registration on 15th March 24, but the order was made on 30th March 24, affecting cancellation with effect from 15th March 2024. Okay, so the company will now need to file its final return by what date? And if we look at the provisions for final return, so the final return is to be submitted in form GSTR 10, and it is to be furnished within 3 months from the date of cancellation or date of order of cancellation, whichever is later. So later of what? Date of cancellation or date of order of cancellation, 3 months from that. So date of cancellation is what? Date of cancellation is 15th March and the date of order is 30th March. So later is 30th March. So 3 months from 30th March is 30th June. So by 30th June 2024, the final return needs to be filed. The next question is, which of the following statements is correct in respect of e-way bill generated for goods in the month of February for which order was cancelled? And in the question it is given in February, the company generated e-way bill for interstate move transport of goods. However, immediately on generation, the buyer cancelled the order before it was dispatched from the factory. So e-way bill needs to be cancelled. And the correct answer is e-way bill can be cancelled within 24 hours of generation. Because the provision for cancellation of e-way bill says that where an e-way bill has been generated, it can be cancelled electronically within 24 hours of its generation. Okay. Seventh, ABC Insurance Limited received a proposal. Okay, so this is the question, and then we are asked to determine the time of supply of service, and the correct answer is given as 5th of August. How have we arrived at this answer? So ABC Insurance Limited, so this is an insurance company, and pandemic insurance is supposed to be provided. Sum assured is 20 crore with a premium of 5 lakh. The company issued the policy on 1st July, invoice issued on 5th August, and premium received on 14th August. So this service is liable to GST under forward charge or reverse charge. Reverse charge is not applicable, of course, so forward charge is applicable. So we need to find out the provision for determining time of supply of services under forward charge. Time of supply is earliest of the following dates A, B or C. A, if the A is what? Date of issue of invoice. If the invoice is issued within prescribed period, or date of provision of service if the invoice is not issued within prescribed period, and C is the date of receipt of payment. So the question is whether invoice is issued or not issued within the prescribed period. So for that we need to figure out what is the prescribed period for issuance of invoice. So tax invoice is to be issued, and this is the regular case, and supplier is an insurer. Supplier is insurer, so the invoice is to be issued before or after provision of service, but within 45 days from the date of supply of service. So within 45 days from the date of supply of service. So policy was issued on 1st of July. So within 45 days, the invoice needs to be issued. And since it has been issued on 5th of August, it has been issued within 45 days. That means within the prescribed period. So time of supply therefore will be what? Invoice is issued within prescribed period. So time of supply will be date of issue of invoice or date of receipt of payment. Date of issue of invoice. Date of issue of invoice 5th August or date of receipt of payment 14th August. The earlier of these two dates is 5th August. So therefore 5th August becomes the time of supply. Last question is regarding Mr. Naresh, who issued an invoice to a customer and erroneously charged a higher value of by 42,000. And the invoice was issued on 28 March. Which document is required to be issued in respect of the invoice issued? So since this is an overcharging, therefore obviously credit note will need to be issued for 42,000 to bring down the amount by this particular level. So credit note will need to be issued. So this is all in this video. So if there is any doubt or you need any clarification, whether on MCQs that we have discussed in the video or even otherwise on any other question, descriptive question contained in this particular MTP, then just write to me in the comment box. Or if you are a user of my website taxbasharad.com, you would definitely be having my WhatsApp number. So just ping me on WhatsApp, or alternatively write in the comment box and I will reply to you as soon as possible. See you very soon in my next video. All the best to you. Good luck and goodbye.